Good morning, everybody. We're going to give everyone a minute or two to get connected in, and we'll get started in just a sec. So sit tight. We'll be started in just a sec. I love to hear where everyone is connecting in from. So let me know what market you're in. All right, letting everybody join. This is terrific. We're all over the place, all over the country. Terrific. All right, everybody, going to give everybody just one more minute to get connected in. See the numbers are climbing. It's great to see everybody. It's finally snowing in Boise. It's snowing in California too, a lot. And it's finally not snowing in New York City. All right, everybody. All right. Let's get rolling. Thank you, everyone, for joining us today. We're going to talk about the 2026 housing market, the ideas, the things we've got coming. We have the latest data through Friday to talk about where things are, what we can already see happening. There's a lot of people from all over the country. We have the chat open. We have Pooja and Parker from the Compass team in the chat. I won't be able to answer questions on the fly, but you can put questions in there and we'll be collecting them. And I have saved a few minutes at the end of the session today to do a little Q&A. And so we'll collect them. If there are things that you are interested in while I'm talking or a little clarification, please drop a question in there and we'll try to get as many of those as we can. We'll save a few minutes at the end. I'm Mike Simonson. I'm the chief economist for Compass. And we're doing this webinar externally for the first time since I've joined Compass. And we have a lot of people registered to join us today, a few thousand people registered to join us today. I do these internally in Compass now. And so this is the first one we're doing externally. And so I'm glad you've joined us. Stick around. We're going to talk about a lot of the data, the latest data in the housing market. If you don't already follow me, I'd love to connect with you on social. We do a weekly video and email newsletter. If you scan this QR code, you can get on that weekly list. It's a Compass email list, but it's public, so you can get it for yourself and you can share it with other people. It is a link to our weekly video on YouTube, plus the commentary. And for folks inside Compass, they also get assets like social assets and the charts and things like that. But the analysis is for everyone. So feel free to scan that QR code, join that list. Love to. It is our mission really to help everyone understand what's happening in the housing market right now, and this is part of it. You can also connect with me. You can follow Compass directly on YouTube, where I post those videos. You can also connect with me on Twitter and LinkedIn. That's where I do most of my market data analysis posting. I'm also on like Instagram, but I don't do a lot of data there, but happy to follow me there too. So that's where you can connect with me. I will look for your request today, and like to share a lot of data. Okay, let's dive in. So, looking at 2026, we created a forecast and market outlook for 2026, which we released in December. And the theme of that outlook was that 2026 is really the next era for the housing market, the next phase. In the previous phase, the previous 4 years, was one really marked by very low sales and relentlessly rising prices. So affordability continues to get worse. That's the old era. In the new era, inventory is now built sufficiently high in most of the country that prices are softer. So incomes can rise faster than prices. So sales can climb and affordability improves for the first time in years. Incomes are rising faster than home prices, even in places where prices are up year over year still. So affordability returning, slowly returning to the market is a nice theme for 2026. We have mobility in 26 that has been frozen in place for several years. People who moved, a lot of people moved during the pandemic, and then we've stopped. It got more expensive to move. We've slowed down. We're holding on to jobs. And as a result, that mobility has been really locked in place. That's one of the reasons that sales have been so low over the last 4 years. This year, we start to see a little more mobility unlocked. We have, though, meanwhile, a divided economy. You might have heard it called the K-shaped economy. There are two legs of the K. There's an upper leg and a down leg. There's some folks are doing very well. Some folks are under pressure in this economy. For example, the stock market, basically at most of the equity markets are basically at record highs. Uh, but but if you are unemployed now, it's really hard to find a job. So unemployment is low, but it's hard to, the companies are hiring fewer. So there are two legs of the K-shaped economy. The real estate has a K-shape. There's a divided economy in the real estate market, and I'll show you that in just a second too. So this divided economy creates a bunch of trends that really drive what's happening in the U.S. right now. I'll try to point some of those out, and it also makes it very difficult for policymakers because in some ways the economy is growing very fast, and if you are looking at that leg of the K, and you're on the Fed, it looks like we should raise interest rates. If you're looking at the low end of the K, where the economy is not growing, then it looks like we should cut interest rates. And so, as a policymaker, this divided economy makes things very difficult and it drives a lot of what we see happening right now. So, those are the big themes for 2026. As we're talking to folks, home buyers and sellers this year, one of the things that may become more and more common is the headlines may say home prices are down year over year. Home prices are still up a little bit, nationally, but they may turn negative nationally sometime during the year. Some of the metrics, as I'll show you in a little bit, are actually negative year over year with home prices already nationally on average. Uh, However, if we look at price to income, the price to income ratio, not even including mortgage rates, just looking at the price of homes and incomes over time, we can see this chart. The Over time, homes have grown less affordable. Home prices climbed faster than incomes. And so we got to this range of 5 to 6 times annual income for the median price home. And in the least expensive markets in the country, that's like 10 times your annual income for the median price home. In more affordable markets, it might be 4 or even 3 times income would be an affordable market. So what we can see is that we are finally in a position where home prices are not rising fast or maybe even falling, but incomes are ratcheting up higher still. And that means as a price to income ratio, we finally get some recovery in affordability. So when we're talking with folks about home prices this year, one positive framing is that for the first time in many years, affordability is improving in the US. And I think that's a positive for the country. While I'm talking about this, so this was on a chart and a data and write up that we did in our big forecast, the 2026 Market Outlook report, which we released in December. In the chat, Parker Puja will include a link to where you can go to a website. You can actually download. The report is 70 pages long. It dives into all the data and all the analysis, and it looks at the positives and negatives. It looks at potential scenarios for what's happening. This affordability trend is something that's is optimistic for the year, and it's even in a world where home prices might decline for the year, which would normally be a scary headline. In this world, this is an improving affordability. So that's something to keep in mind. So if you want to dive into the conclusions and all the details and the analysis, go to that report and you can download that. That's available for anybody. Okay, let's talk about the data today. As of this year, mortgage rates are staying in the low sixes. In this chart, each line here is the mortgage rates distribution for the year. So you can see each dot in there is a week, the mortgage rate for that week, and you can see how 2022 had that big change from very low to much higher. In the last 3 years, we've been in this range of 6.25 to 7.5 for 3 full years. In the last 3 years, there have been 3 times now when rates dipped close to 6%, and none under 6 in the last 3 years. So this 6% is really why I've called it the magic number. It's where I see in those 3 periods in the last couple of years that rates dip close to 6, we could see a notable uptick in transactions, home sales, as well as price resilience. And so we can see demand improve during those periods where we've gotten close to 6. Now we're in 3, 4 months at close to 6%. And I'll show you where we can indeed see home sales growth, and what it's implying for prices as well through the whole market. So the good news is that rates are dipping lower. Our forecast for the year is really hard to imagine rates getting dramatically under 6%. There's a lot of underlying forces that are actually keeping mortgage rates higher. And in fact, if we get unlucky and say inflation data comes in hot, rates could push the other direction. We've been lucky in the last few reports, both the jobs reports and the inflation reports have been favorable for rates. So we're staying in the low sixes. And if we get lucky in February, March, April, as the peak home buying season kicks in, if we get lucky and we stay at 6 or a dip below, that will actually add, I think, a nice set of demand to home buyers in the first quarter. Last year at this time, rates were at over 7.1, so 100 basis points higher a year ago. And what that means is if you look at payments level, uh, payments on the median price home in the country now are 8% cheaper than they were a year ago. So in this chart, two lines here. The purple line is the curve for 2025, and the blue line is this year. So as home prices go up, which they peak at the end of June, uh, this number goes up, but it also goes up with mortgage rates. So this is a payments view, which is how a lot of people make their purchasing decisions. And so it's 8% cheaper than last year at this time. In markets, I was in Chicago yesterday talking about the Midwest. Chicago and Milwaukee and many of the Midwestern cities still have very tight inventory. Home prices are higher than a year ago. And even in those markets, so in the Chicago metro area, payments are still 6% below last year at this time, even though home prices are higher. So that is an optimistic bit of news for potential buyers and sellers this year. So because for sellers, they need to know if there are buyers uh, available. And so every little bit helps. And this is certainly, we can see it in the data right now. So That's the view on affordability. Affordability as price to income. So incomes rise faster than prices. But then if we're lucky, as we have been recently, it's not just incomes and home prices, but it's also rates. So we get a double benefit and we improve affordability for the first time in many years. So that's optimistic, and we'll see how many buyers take advantage of that. But every little bit counts, and every little bit frames up a little bit more opportunity. Um, okay, this is maybe the most important chart of the housing market for 2026. This is days on market per state. In the bluer states here, the bluer the state, the shorter market time, the oranger the state, the longer market time. And so you can see a really distinct north-south divide. The shortest time on markets are Midwest and Northeast. The longest time are across the Sun Belt. So what's going on here? Why is that? As I was there, I was in the Midwest yesterday, and I said, well, how did Milwaukee get to be the hottest market in the country? Well, here's what's happened. For many years, we've been moving north to south. We sell a house in Chicago to move to Denver or Phoenix. We sell in Buffalo or Milwaukee. We buy in Orlando. And that's been many decades in the works. As it got expensive to move, not just uh, interest rates, but also insurance and washing machines and all of the other factors, we've slowed down that move. We've stopped moving. And in fact, places like Tampa, Florida actually had net outbound migration last year for the first time in a bunch of years. So uh, so that north-south migration means we used to sell in Chicago and buy in Dallas, but we're not selling in Chicago right now. So if I am a young family in Chicago, I used to buy from the guy who moved to Orlando, but he didn't move. And I still need to buy my home because I still need an extra bedroom. And so demand relative to supply has remained tighter across the Midwest and Northeast and has grown across the Sun Belt. So we have you can see it real stark. And we were talking about I was talking with an agent in a Coldwell Banker agent in LaGrange, Illinois yesterday, and she was talking about how extreme it is there. And LaGrange is outside of Chicago. It is a place where young families move from the city out to the suburbs, and this pain is really acute because there isn't inventory for those families. And meanwhile, across the Sun Belt, there's a lot of inventory. Florida and Texas are at record high levels of inventory. We build a lot of houses down there. And therefore, the time on market is much longer. It's also where the home prices are softest. So home prices are staying stronger across these bluer states, and they're negative in many of the markets across the Sun Belt. These are so the question is, when does this change? And I've called this the great stay because it's actually not just a housing uh, scenario. It's not just a mortgage rate problem. This is also a jobs problem. Companies, unemployment is actually very low right now. We all basically have jobs, but hiring is very low. And because hiring is low, if we're doing what we call job hugging. So if I'm that family in LaGrange, I don't move to Phoenix because I'm worried about getting a job in Phoenix. But I've got my good gig in LaGrange, and so I am hugging that job. I'm holding on to my good gig with my cheap mortgage, and I am afraid to move. So the number that I am looking for, the macro number that I'm watching most closely for 2026, is the hiring rate. So this is a hiring rate over 26 years. And the gray bars here are recessions. And you can see during recessions is when hiring rates fall. Companies don't hire during recessions. We're not in a recession now at the right end of the chart here. We're not in a recession now, but the hiring rate looks like a recession. Companies are not hiring. And that means if companies are not hiring, I'm afraid to move. So if we get lucky, the macro trends turn in the favor of businesses and businesses can start to expand payrolls again, this hiring rate turns up a little bit. Now I'm more confident in my ability to leave my job in the Midwest to start a new job in the Sun Belt. That unlock of that mobility can start again. So this is the number that I'm watching most closely. 3.2% is very low hiring rate. It hasn't ticked up yet. This is a function of a bunch of things. This is companies hired a ton during the pandemic. This is maybe AI companies that have they're turning to AI rather than hiring new people. This is also an interest rate thing. So the cost of money is high for companies to borrow to expand. All of these things are turning into play. But the important thing is that mobility, that north-south mobility, that buying a new home. So we're staying in our house, we're staying in our town, we're staying in the region, and we're staying in our jobs. We're staying in place much longer because we got a good gig that we don't want to change. If we see hiring rates tick up in the year, that would be an optimistic notion for me to see that more people will feel confident about moving across the country, moving to a new gig, and we'll start to see the results in more inventory in the Midwest, less inventory in the Sun Belt, as well as stabilization and increases in transaction volume, et cetera. As of right now, there are 690,000 single-family homes unsold on the market across the country. That's 8.2% more than a year ago. So inventory is still climbing over a year ago. It's only 8.2%. We are forecasting for the year that inventory grows by 10% for the year, so keeps growing a little bit. But here's what's interesting. Last year at this time, inventory was up by 35% year over year. Last year, this time in Arizona, for example, inventory was up by 50% over the year prior. Now, though, in Arizona, it's up 6%. Nationally, we're up 8%, and that 8% number is shrinking. So the growth rate of inventory is shrinking. And you might be surprised, but Florida, which had basically unrelenting inventory climbs for 3 years, no seasonality at all. Florida inventory peaked last June, has been trailing lower, and Florida now has fewer homes for sale than a year ago. So this is a very different market than a year ago. Yeah, a year ago, inventory is exploding, right? There's more homes on the market. There are sellers who are frustrated. There are price reductions. There are seller withdrawals. All of these things that are happening. And as of right now, we have better affordability. We have some bargain hunters in those Sunbelt states. There's ample inventory, so that means more sales can happen. Sales are still restricted by inventory in the Midwest and Northeast. Like, you can't buy what's not for sale. So inventory growth, we have almost back to normal. The gray bar here is the pre-pandemic. So there's still fewer homes now than any time in the 2010s decade. But there are, you can see that we're just growing just a little bit. It's a very different message. If you may have buyers sitting on the fence who are just saying, I'm just going to wait until there's a crash, till there's a ton of homes. There's going to be a flood of inventory, and then I'm going to swoop in for the bargains. The question is how long you're going to wait, because there's no data right now that shows inventory rising quickly. In fact, it's actually compressing. If rates dip lower, let's say rates dip to 6 or under 6, we could be at negative inventory. It could be less inventory by June. And that would be a fascinating difference. As of right now, we're still forecasting about 10% inventory growth for the year. But we're coming in under that. So I may have to revise that down. And in fact, here's a view. So this is showing Texas, California, and Florida. And over the past few years, you could see at any given moment how much inventory had grown. So Florida in middle of 24 had 70% more homes for sale than the middle of 23. Last year, it was 40% more. California was 60% more homes than the year prior. And now Florida is down negative 4%. So 4% fewer homes for sale right now in Florida than a year ago. And if you look at that line, it's still moving down. So inventory was climbing rapidly last spring. It is not climbing as rapidly now. So each week, that difference grows. Texas is still positive by 10%. So there's still a lot more homes for sale in Texas. But, Texas was 40 or 50% inventory growth before. Texas is easing down each week, and fewer, that growth rate is less. And it'll be fascinating if Texas gets to negative. So these are the three biggest markets: Texas, Florida, and then California, in terms of homes for sale and home sales each year. So are we going to get a flood? Are there going to be a lot of new listings? Are there going to be a lot of sellers this year? This is tracking last 3 years. At the left end of the chart is the blue line for 2026. This is the new listings volume each week. If we're going to have a lot of sellers, if those buyers who are waiting for whatever going to happen, if they're waiting for a flood of sellers, they should know this data. And the data, it shows that in the last few weeks, the new listings volume has come in under 2025, so fewer sellers each week. In the last few weeks, this is still reflective of the big ice storms and the deep freeze of the last few weeks. And in fact, in the data, I'll show you a few places. We had good growth. You can see here in January at the very left end of the chart, there were slightly more sellers than a year ago. That, I think, is optimistic to me. That means there's seller growth in the Midwest. That means there's seller growth in the Northeast. So we want to have a few more sellers. And this is single family homes. There's another 20,000 condos in this mix. So you get a little bit, you can see a little bit of the growth there. You want to see a little more growth. We want to see slightly more sellers. In general, sellers are buyers also, so those imply more transactions. After the deep freeze, of course, the new listings volume drops way down. I expect that next week, in the next week's data, this blue line is going to pop above the purple line, and we will start to see some new listings growth. I do not expect to see a big upswoop in the new listings, but that's something we want to keep our eye on. And, if you have a hypothesis that there's going to be a ton of sellers, that they're just waiting, that would be how we would confirm it. As of now, there's really no evidence of a ton of sellers coming. And we're looking for just incremental growth. A little bit of growth will make this a healthy market, more people that want to sell and want to move and buy another home. So watch the trajectory of this data in February, March. A big trend, a big theme of the year has been the delistings. These are sellers who tried to sell a home, didn't find an offer they were happy about, and withdrew or delisted. I've shown here, this is as a percent of new listings. So what percentage of people who try to sell are getting frustrated? Each line here, you can see, has the jump over the holidays, right? We do a lot more delistings over the holidays and try again in the spring. As of right now, the blue dot is January at the left end of the chart, 44%. So in January, there's still plenty of delistings. So these are sellers who try to sell, but then get frustrated, and then they pull the offer. So that it is very easy to think of this data as just supply. These are sellers who wanted to sell but couldn't sell. And so when conditions improve, these are sellers who are going to come back. It's very intuitive, very easy to just look at it as the supply side. But in Compass, when we looked in the data, we could see that most of these folks are owner occupiers. And that means that these are two transactions. These are a sell and a buy. So when conditions improve, these delistings become relisted. They get offers. These are really two transactions. This shows us demand as much as it shows us supply. If these were, for example, investors, that could be just supply. They're just investors that wanted to unload and couldn't. But that's not what we see when we look at the data here. So we're really thinking that this delistings trend shows demand as much as it shows supply. And I think that is not initially intuitive. And it's important for the conversation with buyers and sellers right now. And in fact, if you're having the conversations with somebody who delisted last year, they delisted waiting for better conditions. And guess what? In many ways, better conditions are here. Payments are 8% cheaper than they were a year ago. So we're starting to see the delistings relisted now. So in this one, each column is a count number of homes relisted. And so 77,000 single family homes were relisted from last fall. They were withdrawn last fall and they're relisted now. You can see it's about 14% more than last year. So the blue lines are this year, and the taller the line, the more homes. So there are more relistings now. It's also a conversation that if I were having with a potential seller now, I would let them know that if the folks who didn't price right last fall had to withdraw and relist now. So we want to be ahead of this curve, not behind it. It is an important factor. It shows supply and demand. It shows also that inventory isn't really rising very quickly, but there are the relistings in here. So they are not surging inventory as like a great pile of supply hitting the market. Okay, let's shift into the sales numbers real quick. So we track at Compass, we track the weekly pending home sales. So these are the homes that go from active to closed, active to not active to closed, active to pending in a given week. They take offers and go into contract. And you can see the blue line in January was above the January of last year by like 3, 5, 7% each week. The more sales, more weekly pendings were coming in. As the ice storm hit, the last few weeks came in under last year. And so we're right now at the same pace as a year ago. Cumulative year to date, we've got about 2% more sales pendings that have happened, but that storm really took a couple of weeks out. I expect next week this will climb again. I'm using a 4-week rolling average here. So what we're showing right now is really, through mid-January. And so a couple of those weeks in there came in low, and sales dipped below last year during the storms. And that's, a big chunk of the country. So we are forecasting 5% sales growth for the year. It's not a huge growth year, but it's like going from, say, 4.1 million to 4.25, 4.25 million existing home sales during the year. So it is real growth. It's consistent growth, but it's not huge. There are conditions in our big outlook report, that big report that we explored to say, what would it take to get maybe 10% or like a big growth year in home sales? And we called it the Goldilocks scenario. The Goldilocks scenario requires rates to dip low in the first and second quarter. We're actually there even, but maybe a little lower dip. It would also require that hiring rate to kick up a little bit, because we want to see more people in the Midwest and Northeast list their homes for sale, move, maybe take a new job. That would allow more sales to happen. So it's not just mortgage rates, it's actually things like hiring that would have to conspire to get us a big growth year in home sales improvement. But well, here's what's interesting. A year ago, I did for Housing Wire a forecast where we were thinking that we might see 5% sales growth. In the first few months of 2025, though, rates jumped up to 7%, 7.1. And each week, these weekly pending sales were coming in below last year and the year prior. And so now they're coming in above. And with the exception of the storm weeks, and then I think they're going to start moving back higher. So far our 5% sales growth forecast seems on the nose. Seems like the data is coming in to support it. And let me show you why I think the data was because of the storms. So this is if we're looking at sales rates by part of the country, it looks pretty much like the weather map. The Western US has been warm and dry. The Eastern US has been cold and snowed in. And the further north and east you go, the less sales growth there has been, including these last couple of weeks. The Southeast, in fact, is still negative year over year. Florida, though, has 6% sales gains in the weekly pending sales over last year. So this negative is really from Tennessee, North Carolina, Georgia in the last couple of weeks. And so I think as we thaw out a little bit on the East Coast, I think we're going to see consumers starting to take advantage of lower rates, a little better opportunity, and see these sales turn positive across this part of the country as well. So it really looks like the weather map of the last few weeks. And I think you can see in the Rocky Mountain states, sales up very strongly over last year, and I think that's reacting to the cheaper mortgage rates. In the Compass data, we have some really powerful things. So Compass is the largest brokerage in the country, and we have an amazing technology stack that the agents use. We are doing things now where in the Compass platform, agents can show home sellers how many buyers are looking for homes in their price range of the quality they have, and present them with this buyer demand to understand pricing for your listing. It's a really cool, powerful tool. And in the data side, we can now use that to understand changes in demand and over time. And what we can see is how now consumers, the demand data is coming in about 8% stronger than 2025. And so even though we have the dip in weather in the last couple of weeks, we can still see the uptick in demand, and we can see it in terms of numbers of people shopping for homes. There's another place you can see demand indicator. The MBA does the purchase mortgage application. So these are people applying to buy homes, for mortgages to buy homes. And there's an index, and they release it each week. It has been, you can see I've got 4 years, 5 years of data here. Last year, in the second half of the year, that number started rising, not nearly as much demand as there was in the first quarter of 22 when it was still crazy pandemic. Everybody's trying to get their deal done before rates rose, but rising. Where 22 was falling all year, 23 demand kept falling all year. So 24 didn't recover at all, but 25, the mortgage demand started to pick up. And in fact, significantly higher, 10, 15, 20% more mortgage applications than a year prior. 26 has started strong. I think we'll probably tick above that yellow line for 2023. It's the highest level of mortgage demand in 4 years. I think in the next couple of months, we'll see that, maybe even the next few weeks. It's not a lot of demand, but it shows improvement. So we can see improvement in demand in the Compass data. We can see it in the mortgage applications data, and we can start to see it in the actual pending sales data. And I think all of that falls through to ultimately to the number of sales. We can also gauge demand. One of my favorite gauges of demand is the price cuts. So this is the percentage of homes on the market with a price reduction. There's always about 30% of homes take a price cut before they sell. Sometimes that's intentional, sometimes it's accidental, sometimes it's a crazy seller who's trying to fish for deals. But when the market's hot, those crazy sellers, those fish, they get their bites. And so sometimes it's price reductions are as low as like 10 or 12% in the pandemic craziness. In the last few years, been a lot more price reductions. Right now, 32.4% of the active listings have taken a price cut So the blue line at the left end of the chart. Here's what's interesting. Last year at this time, the purple line, price reductions were already climbing. They were already climbing because rates were climbing, demand was falling, and now the opposite is underway. And you can measure demand improving here because the price reductions number is dipping. In 23, that's the yellow line. We were coming off the fall of 2022 was when demand fell off a cliff. Rates jumped all the way to 7%, 7.5%, was totally surprised everybody. The end of 22 was really slow. By 23, rates dipped to 6. This is one of the other 2 times that rates have gotten close to 6% in the last few years, 4 years. And you could see how in this yellow line, how consumers were responding to those lower rates at that time. They were taking advantage, and it went all the way into May before price reductions started ticking up. I think we're going to look more like the 24 line here and probably start rising a little bit sooner, but fewer price reductions now than a year ago. The trajectory has been good. That shows improving demand rather than decreasing demand. That's an optimistic sign, even though it's not super, super strong. Okay, let's switch into prices, and then we'll save a few minutes for Q&A at the end. This is using the Case-Shiller index. This is the rate of change of home prices over years. So each city has 0, 5, 10% home price changes over the previous year. And so this is a couple of years of data. And the thing to notice here, the purple ones are cities where home prices are above last year. The orange ones are cities where home prices are below last year at this time. So about half of the markets have home prices below last year at this time. And I think what's most important about this view is the trajectory. Each of them, even in Boston and Chicago and Cleveland and New York, where inventory has been tight and prices have been elevated, still staying up, the rate of growth is falling. So where Chicago was 7% growth, it's now 5% growth. I looked at the real-time data in Milwaukee yesterday, and it went from 6% growth to down to 3% growth. So you can see that even in those cities where inventory is tight, the price pressures are on. This is because nationally inventory is great enough. We have broader economic concerns. We have all the affordability things, and we have had 2, 3, 4 years of rising inventory. We've had 4 years of higher mortgage rates. All of those factors have conspired to bring the momentum down. The blue, the national, is in the lower right. Home prices up by this measure 1.7% over last year. That's getting lower too. The only market that has a notable upturn in prices is San Francisco. And San Francisco is really started last June, and that was it's really a function of, it seems, the boom in AI investment. And so rents are up big in San Francisco too. And so you can really see that change. And it's notable that AI investment boom is not in other tech hubs. So it's not in Austin. We don't see it in Seattle. It is or Boston. It's really San Francisco focused. So that's the national view on price changes. And so if you're talking with buyers and sellers this year and they say, "Oh, how's the market?" I hear home prices are down. You know, my reminder is that affordability is improving for the first time in many years, and we got to view that as optimistic for the country. So, and you can see it even in those tight inventory markets. If we look at asking prices, the asking prices across, so this is looking at every home on the market every week, and you can see that it is really started the year below the current ask price is $420,000 median price, and you can see that it climbs through May, June, and then declines for the second half of the year. And we've been coming in below last year at this time. And so, in fact, below the last 2 years. So in many ways, basically unchanged prices. And our forecast is for essentially unchanged prices for the whole year. And so we call it 0.5% up for the year. And in our big forecast report, that big 2026 outlook document, I go into the math and the big models about how you get to that specific and why that matters. But as of right now, we should treat most people in most markets as assuming that home prices haven't really changed in 2 years. What does that mean for how you're going to list? What does that mean for your buying expectations? If you're waiting for prices to drop, what what are you waiting for? Like, is that happening? There's no signal in the data anywhere that prices are dropping rapidly. Even in places like Austin, where they have dropped pretty significantly from 4 years ago, uh, they and have not necessarily found a bottom. They are still seem to be moving much more slowly now. And then let's do the one last view of prices. So some view of prices, they're up 1.6 or 1.7%. Some views of prices are down 1.6%. So if we look at asking price per square foot, which is a nice normalized measure across all properties, those are coming in 1.6% cheaper than last year and almost unchanged from 2 years ago. And so in a in a if an environment where rates jump up this year, you can see that prices are already very sensitive and would ratchet down, I think, pretty quickly. Okay, so that's the whirlwind tour. That's the whole country. Um, Use the QR code. You can scan that to get on the weekly email list that we send out each week with the video and the commentary. If you're in Compass, you actually get social assets and charts, but anybody can get this email, and our mission is really to help everyone understand the housing market. Connect with me on socials. I post a lot of stuff on Twitter and LinkedIn on data that I'm just observing that aren't either beyond that weekly email. But it's all there. And so we're going to switch now to Q&A. And Pooja, did you do a view? Did you grab some questions during the session? All right. How do price reductions work across price ranges? Is it more common for lower or median price or above nationally? Okay, so price reductions um, in in the ultra high end tend to be longer and fewer and far between. So price reductions at the ultra high end tend to be like you might leave a home for they sit on the market longer, so you have a longer dynamic there. In It depends on the price range in which market. So, for example, in Indianapolis and Phoenix, there's like a lot of investor behavior, and in those markets, there will be price reductions tend to be more on average. In a place like the Bay Area, we have a chronic shortage of homes for sale, and so price reductions tend to be much lower in those areas. So um, there is a per market normal, and so I like to pay attention when looking at price reductions. How are we compared to normal for the market, as well as the trajectory? Is it going up very quickly, or right now it's dipping lower? Okay. Um, on the relistings, are they pricing better when relisting? So this is going back to the relisting question, which is, um, you know, there were a lot of delistings last fall with relistings. Now we can see that most of those folks do a price reduction during that time. About 3% do a price increase. And those folks probably did things like, oh, I have to fix the kitchen before we can sell this house. And they take the house off the market and they do a refresh. And then they sometimes come back on with a higher price. So it's about 3% of the time. So most of those folks are doing price reductions when they relist. And that price reduction is about 3%. So if you think about the median price home is close to 400,000. It's about a $12,000 price reduction. Is 12 to 15,000 is about the price range of the price reductions that we're seeing. Are we entering a market where pricing strategy matters more than timing? Oh, this is a really interesting one. Okay. Um, People always like to try to time the market, but of course, timing the market is a fool's game. And so I'm of the view that pricing strategy is much more important than timing. The right priced home moves, the wrong priced home doesn't, and it doesn't matter. We're not in a case like the pandemic craziness. Like, it is now a time to try to smartly price the home. And timing, like, you could wait for better, but what if you wait and suddenly the inflation numbers come in and mortgage rates are higher now? Like, I don't know what timing the market's going to get you. If you like the house and you can afford the house, buy the house. If you don't like it or you can't afford it, don't buy it because you think you have to, because you think the timing is right. My guidance is always, if you like it and you can afford it, then buy it. That's how I approach timing. Okay, here's a question: how much importance do we give on market data when studying the market? What are KPIs that give you a holistic view of the market? KPIs. So things that I care about are the inventory numbers, and it's not just the inventory numbers. It's like answering: is that a lot? Is it a lot of homes? Is it few? Is it growing? So a lot of folks are actually nervous about the data, and so my recommendation is to say start with one number. Let's start with inventory. There are only 12 homes for sale in town. Oh, you're a realtor? How's the market? I hear home prices are down. Well, you might be surprised. There's only 12 homes for sale in the market. Last year at this time, there were 18. That actually shows me this. And then you transition into the questions. Tell me about what you're thinking. The inventory. So inventory is a super easy one. And is it growing? Is it shrinking? Is it more than last year? Those kinds of things help me answer, how's the market? I like that price reductions number. That price reductions number tells me about demand. Is demand stronger or weaker than normal? I like the new listings volume. Are there a lot of new listings coming onto the market? Like, is inventory going to grow in the future? Those are a bunch of the numbers that I like watching as sort of KPIs and good conversation topics. What technology does Compass use to determine current buyers shopping in a specific area? So I mentioned we have this really amazing in the Compass platform, which is super strong. We have this buyer demand tool that agents are using now. And what happens is buyers can build folders and they can put the properties that they like in those folders, and they can shop and they set their price ranges. And so because they're using the platform, we have so many people using this platform that we have real insight about what they're putting into the folders, how quickly they're adding homes to folders. Are they seeing the homes that they want? Have they come back to a folder that they shopped last summer, but then stopped for the fall, and now they're back? All of these momentums are things that we can look in the data, in the Compass data, to determine buyer demand and the momentum of buyer demand. It's super cool. It's fun for me to be able to play with in that data. All right, we'll do one couple more here. Let's see. Oh, can you say what you mean personally between supply and inventory? I generally use those interchangeably. However, so there are, inventory is active inventory. So these are the homes for sale on the market. There are other things that you could add into supply, like how many new listings are adding to supply. So when you're talking about the supply side of the supply demand equation, it's not just inventory. Like, are there a lot of new listings coming in? Is inventory going to climb? Is demand low? So even though we don't have a lot of new listings, inventory is going to climb. Those are how I view the difference in the concept of inventory and supply. Relistings are part of supply, but really, I think about active inventory. How many homes are on the market now? Can I buy them? I take pendings out of active inventory because like those are in contract. If I'm buying a house, those are not ones that I can buy right now. Houses that were active on the market in the first week of February and are now in contract now are not in active inventory. They're not in supply. So these are things that I use when I talk about supply and inventory per se. Let's do one more and then we'll let everybody run. How should agents be advising sellers differently right now versus 6 to 12 months ago? Okay. 6 to 12 months ago, rates were high and moving higher. Now that the average mortgage payment is 8% cheaper than last year at this time, it's a very different market. We have more homes for sale in most of the country, so supply is better. But also, so that means better selection for buyers, but for sellers in most of the country, there's generally more homes for sale, and so we have to be wise. Even though the demand, we can see more buyers in the market, we still have to be very wise on pricing if we want to be ahead of the curve and not behind the curve. Buyers are in the driver's seat in most of the country. They can wait and not act on an overpriced house. All right. All right, everybody. I think we'll wrap it up there. I really appreciate your time. I hope we can help you help everyone understand the housing market. Thanks, everyone.